Which is the best dividend ETF episode 2? SCHD. How are you guys doing? Welcome back to the channel. For today's episode of our series Best Dividend ETF, we will be featuring SCHD, or also known as Schwab US Dividend Equity ETF. The Schwab US Dividend Equity ETF aims to hold high-quality US companies with strong 10-year track records of maintaining or increasing their dividend. The ETF charges an expense ratio of just 0.06%, making it a truly low-cost way for investors to get access to a bundle of high-quality dividend-paying stocks. Just as we talked about in our previous video, an exchange-traded fund or ETF is a type of pooled investment security that functions much like a mutual fund. Typically, ETFs will track a particular index, sector, commodity, or other assets. But unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock can. Now, if you'd like to know more about SCHD ETF, make sure to watch till the end to have a complete outlook on SCHD. Please hit that like button and subscribe button to support the channel. Without further ado, let's begin. SCHD aims to track the Dow Jones US Dividend 100 Index and has done so excellently. It also consistently exceeded similar peer ETFs such as the Vanguard Dividend Appreciation ETF and the iShares Core Dividend Growth ETF on most timeframes, while also paying a higher yield, meaning that performance adjusted for dividends would do even better. SCHD rebalances quarterly and reviews its composition annually. The ETF is easily liquid enough for most, if not all, retail investors and even option traders. Ultimately, SCHD remains a preferred ETF for many investors looking for high-quality businesses that can grow their inherent value over time while also paying out some profits as dividends. Here are some reasons why SCHD should remain in one's portfolio. Recession-resistant holdings. SCHD has been through many rebalances and composition modifications. Lately, the fund has been buying companies that tend to be resistant to recessionary pressures. Companies like Merck & Co., PepsiCo, and Coca-Cola all tend to hold up well in recessions. Merck, which manufactures pharmaceutical products for both humans and animals, is unlikely to see sales or earnings impacted greatly during a recession, as people will continue to prioritize the purchase of these potentially life-saving products. While Coca-Cola and Pepsi tend to also be recession-resistant, as humans are creatures of habit and cut out their favorite beverages and snacks only when truly necessary. Amgen is yet another healthcare company, as is Pfizer. Verizon also should hold up well in challenging economic times as people continue to use their telecom services. Home Depot is arguably more exposed to a recession, with people cutting out or holding off on expensive home improvement projects. Overall, the current composition of SHD's top 10 holdings, which make up 42% of the entire fund, seems very well arranged in a recessionary environment. Most of these companies' products will continue to be purchased even when times are tough. That is why SHD's holdings are recession-resistant, as they will continue to grow and, might I say, consumed by people, as companies under their holdings are essentials such as consumer goods and technology. In addition to that, being immune to the recession makes many of SCHD's top holdings maintain pricing control and are therefore inflation-resistant as well. This was evident in Pepsi's recent earnings report, where they beat on the top and bottom line thanks to cost controls and the ability to raise prices by 12%. Obviously, Coca-Cola will have a similar ability to raise prices, as these companies are effectively a duopoly in many beverage countries. SCHD's healthcare holdings presumably have an even greater ability to raise prices, as people will simply pay whatever it costs for many healthcare products. Although we don't really see any in the top 10 holdings, SCHD's current largest sector is financials. As many financial companies often have some sort of percentage transaction fee in their business model, they should do relatively well during an inflationary environment. Number 2. A pullback is an opportunity for longer-term investors. SCHD has pulled back over the last few months and now sits at a double-digit percentage lower than its all-time highs. However, compared to the S&P 500, represented below by the SPDR S&P 500 Trust ETF and the Nasdaq Invesco QQQ Trust below, SCHD has held up better. Given that inflation and a potential recession remain key risks to broad markets, I think that a pullback in an ETF with a portfolio that is resistant to these risks such as SHD remains a strong choice for investors. Thus, investors should consider this current pullback in SCHD as an opportunity to buy some outstanding high-quality companies with a bit of yield income to boot. Number 3. Risks. Although a recession and inflation continue to stand as risks to whatever companies, perhaps the more significant risk here for SCHD specifically is interest rates. With the US 10-year Treasury yields nearing 3%, SCHD's 3.4% yield is perhaps not enticing sufficiently for some given there remains equity risk that bonds do not have. Then again, bonds have inflation risk, something that SCHD is likely more resistant to, which probably makes investors want to consider an approach that is balanced correctly for them. As of September 2022, SCHD has a dividend yield of 3.35%. Under the SCHD holdings, their highest sector allocation is undeniably financials, which has a 20.09%, while technology is a 16.47% and consumer goods at about 6.32%. These three are currently the top allocations of SCHD's holdings. Under the category of allocations, here we have the top 3 companies that are currently operating under SCHD holdings. Introducing the company that has the most percentage of SCHD holding is Texas Instrument Inc., with a total of 4.49% net assets. Followed by consumer goods company, we have PepsiCo Inc., with 4.38% total net assets. Third on the list is a well-known company that falls under consumer goods, that is, of course, Coca-Cola, with 4.34% of the total net asset. With all the companies that are under SCHD, we could definitely say how much it takes to be able to invest in quality ETFs, as it's best to consider SCHD on the investors list. As you can see, SCHD invests in high-quality dividend-paying equities. The fund has outperformed its peers and supplied investors with both capital gains and a moderate dividend yield. Inflation and a potential recession are currently the major macro themes in market. But seemingly, SCHD's portfolio is positioned well for these macro risks. Interest rates rising may have more of an impact on SCHD than other macro risks. Ultimately, SCHD holds one of the best quality businesses that are likely to perform well over the long term. At the end of the day, it will come down how SCHD invests in high-quality businesses that are likely to increase their innate value, making them grow and flourish over time. The equity portfolio's current composition is positioned well to take on most macro risks today. Most importantly, these companies continue to pay some of their earnings out as dividends, and when combined with the recent pullback in SCHD, give the ETF an allocation yield that hasn't been seen in nearly 2 years. SCHD remains one of the top ETFs for retail investors, as it is included in our list of the best dividend ETFs. Well, can you tell the difference between the 2 ETFs we talked about in the previous video? Make sure to leave a comment below about what you think, and please do like this video and subscribe to our channel for more. Thanks for watching.